Hi dear traders! Investors have put the US dollar on the back burner in light of the US GDP data. Yesterday, the first GDP estimate confirmed that the US economy has entered a technical recession. The national economic output contracted unexpectedly in the second quarter. Market participants hesitate to open more long positions on the greenback after the Fed's decision to raise the key policy rate by 75 basis points. Fed's chairman Jerome Powell indicated that further rate hikes might be less aggressive, depending on macroeconomic data. What events which are due in the first half of the next trading week will influence market sentiment? Let us discuss in our regular economic calendar on InstaForex TV channel. In the early hours next week, traders will receive the information that might influence their trading decisions. Commonly, at the beginning of each month, experts of the Market Economics Research Group post PMIs for key economies. On Monday morning, investors will find out about trends in China's manufacturing sector. The manufacturing PMI is expected to remain above the threshold of 50 basis points in July. Experts underscore improvement in China's industry and growing demand under the post-pandemic conditions. Such evidence will boost the risk-on mood and encourage growth of commodity prices and the Australian dollar. On Monday evening, the market will learn similar information on the US factory activity by the Institute for Supply Management. The report will not reveal a rosy picture. The reading is likely to decrease, heading towards 50 points. The fact that the manufacturing sector is losing momentum also confirms a recession in the top global economy. American factories are not so robust under the conditions of high interest rates, as well as due to persistent logistic issues. The same trouble has affected other countries around the world. On Tuesday, the Reserve Bank of Australia will announce the next round of monetary tightening. The central bank is widely expected to increase the cash rate by another 50 basis points to 1.85%, aiming to curb soaring inflation. While employment remains at high levels, the monetary authorities have enough room for such drastic policy moves. On Wednesday, August 3, the market will digest more data on business activity in the services sector, as well as composite PMIs. Market experts will provide revised PMIs for European countries. Importantly, flash estimates for the European Union logged a decline in business activity, whereas PMIs for the UK remained on the positive territory. Apparently, final prints will match the accuracy of the preliminary data. In this case, the market will hardly respond to the PMI reports because the flash estimates have been already priced in. The US non-manufacturing PMI by the Institute for Supply Management is a different story. The US service sector is likely to follow the same negative trend like the manufacturing one. Entrepreneurs moderated their business activity in July under the conditions of high interest rates and sky-high consumer prices. Such headwinds certainly dent demand. Market participants could voice doubts about whether the US Fed will carry on with its hawkish rhetoric, because macroeconomic data reveals worrisome signs. Nevertheless, the Federal Reserve will hardly adjust to its policy decision to PMI. Previously, Fed's policymakers stated that the US economic health should be judged in the metrics of the labor market. The highlight of the next week will certainly be the US non-farm payrolls for July that will be on tap on Friday, August 5. We will discuss the details in the next economic calendar. Don't miss it. Subscribe to our channel and keep close tabs on all breaking news on financial markets.